The broadcast is now starting. All attendees are in listen-only
Good
mode.
evening, ladies and gentlemen, and thank you for being with me today. My name is John Needham. I'll be your host for this webinar, and I'm delighted to have your company, and of course, particularly grateful to see the old faithfuls and the not so old faithfuls who are with us today. We're delighted to have Vicky with us, Toddy's with us, Sarah's with us, a new Danielcode member. So we have two ladies with us today. That's pretty much a record. It's wonderful to have your company. We see Phil's with us, of course. Peter Mack, who's not a day trader, is with us. Many other Peters. Michael Balmer's with us. Michael, are you ashore or are you afloat? Michael's a Swiss gentleman who's been a Danielcode member for a long time. He's done all the Danielcode traces. Yes, he's on shore, he says. That's right. And he's done all the Danielcode courses. And recently, very recently, he did the Danielcode short-term trading webinar, tutorial, I should say. And he had a real blast out of it. He was excited, and you could see that. Michael, I'm well, mate, and I hope you're as well as I am. And I hope your short-term trading is going marvelously. And I'm going to tell you a little bit about that today as we go along. So Sarah's not only with us, but baby Penny is with us as well. This is her first international trading symposium. Good for you, Penny and Sarah. You're starting her off the right way. Okay, let's see what else we've got. Many others, of course. Mark L's with us. Wouldn't be a party without Mark. He's always here. Mal Swift is with us. Mal, nice to have you. Justin, our star back testing guy from the Hunter Valley in New South Wales, Australia, is with us. Jeff's with us. He's recently done a tutorial. And David Webb is with us. And David, a very special greeting to you, my friend. David's been a Danielcode member for years and years and years. He's pretty close to one of the originals. He's certainly one of the early ones. And I'm delighted to have him accompany with us today, David. I trust you're well, my friend. Anyway, lots happening here, and some very interesting times in our trading this week, and I suspect a lot more to come in the not too distant future. So let's get started with it and see what we've got now. You know that markets are rational, orderly, and sometimes predictable. And I added this next line some months ago: survival requires strict adherence to the rules. And I think that's going to become more and more important because this market is at a very, very interesting stage. It's gone past its Danielcode time cycles for a top, and it's facing some perhaps make or break moments. And just to get you thinking the right way, the 2000 top, the dot-com bubble, the dot-com top, came when markets realized that the cost of capturing the eyeballs was not sustainable in the returns that those particular entities were generating. The 2007 top before the 2009 crash, which was spectacular, that came when the market realized that all of the lending, from property lending, mortgages, and the securitization of those mortgages was to a large extent a sham, and a whole lot of that lending was going to be worthless. So that was over-enthusiasm and over-loved mortgages. And that was great fun if you were a trader and knew which side of the market to be on, which of course our Danielcode clients did. And we're now in an even bigger debt bubble. It's the bubble AI, well, certainly AI related. The whole narrative about the benefits of AI to businesses, the cost savings they're going to make, the new opportunities they're going to discover and explore, are generating some massive debts as spending on the required infrastructure is being built out in a hurry. Is the market, are they likely to realise that AI is not going to give those sort of returns in the same way as the great discovery of eyeballs on the internet, the dot-com high, realised that it wasn't sustainable? I suspect it is, but the question is when. So the good news for us is that we not only have some long-term guidance from Frank, but more importantly, you get the daily signals from me. And if you stick with those signals, you're going to always be on the right side of the market. So let's tell you a bit more about that as we move on, because today I want to talk to you about correlations. And the most common quote about correlations, which I'm sharing with you here, not for the first time, is correlations are not causation. In other words, markets can be correlated, but it's not the correlation per se that's driving them. It's the fundamentals, or more recently, it's the narrative. It's all about the narrative. So it's an important part of trading to be aware of these correlations. And if you have time, go to this website. It's called MRCI Online. It's More Research Center. And as long as I can remember, they've been publishing these marvelous charts here that you're looking at, which is the intermarket correlations. And this is one is for 180 trading days. It's a relatively long-term list of markets. And you can choose to get much shorter levels. They have 60-day, 30-day, other levels. And it's a wonderful resource, the MRCI website. So I do urge you to get this particular document. Just educate yourself by seeing what these correlations are. And some of them, of course, we know about. As we tell you continually, all of the US equities and Germany's DAX are highly correlated directionally. We know that gold and silver are highly correlated. We know also that gold and the US dollar have a correlation that varies. At times they're correlated, at times they're inversely correlated. In other words, gold up, US dollar down, or US dollar up, like today, gold down. Some of the ones along the bottom here are interesting. The ones towards the bottom of this particular set of tables are feeder cattle and live cattle. And they're correlated very highly with wheat, which is interesting because the particular wheat that we trade is not stock feed type wheat, it's milling wheat, milling grade wheat, but the correlation's still there. And the other interesting thing is that both feeder cattle and live cattle are highly correlated with the Mexican peso. So you'll see all these correlations here and give you a real opportunity to have a think about them. And they're very interesting. You can see that one here that catches my eye. It's a wonderful tool that you put the cursor on the printed lines in the light blue background. Tells you what that market is. This one here, of course, is, if I'm on the right line, which I am, this is the Russell, which is, together with crude oil, highly correlated with CB. I think that's Brent crude. I think that's Brent oil. Interesting. Do take the time to get it. You'll really open your eyes about a lot of these correlations, and they're important. I've just taken a closer snapshot here, so you can see some of the obvious ones. You can see here. This is the Dow. This column for the Dow, which is highly correlated with the S&P, the Nasdaq. I'm not quite sure what that is, and the S&P, you can see here, is highly correlated, apart from accidental, forgive me, which is correlated with the Nikkei also. Here's NASDAQ, highly correlated with the Dow, the S&P, QR, and the Nikkei. That's the Nikkei there, and you can see some of these important correlations. This is the US dollar index, highly correlated with the euro, and I think that's the SEZ. That's the Swiss franc. It used to be CH something. And here's the US dollar, again highly correlated with the British pound. So some of these are very interesting. Here's silver, highly correlated with the Nikkei. So do take some time to go through those. I find them very, very interesting. And I've been using their site for that information for well over 20 years or so. So some of the correlations that we know about US equities and Germany's DAX, I tell you about that all the time. That's pretty obvious. Gold and silver are highly correlated. Gold and the US dollar index, it switches from an inverse correlation to a direct correlation. In other words, for vast proportions of the time, you will have the inverse correlation. That'll be gold up, dollar down, or dollar up, gold down. And it switches from that inverse relationship to a direct correlation where they go in the same direction. And many years ago, I published an article that's available at the website under the articles tab that did an analysis of that and found that whenever that inverse correlation breaks, in other words, when the pair between the US dollar and gold switches from one up, the other one down, to both going the same way, it's always for the benefit, historically, it's always for the benefit of the price of gold. That's what we've seen, of course, into this present massive rally that we've been getting in gold for a long time. Feeder cattle and wheat, live cattle and wheat, you can think about that yourself, and both those markets and the Mexican peso, which is interesting and also understandable because a very substantial number of Mexican cattle are imported into the US, which annoys the hell out of the cattle breeders in the US. And of course, Trump's facing that dilemma at the moment that he's just authorized a massive 300% increase in the quota for Mexican cattle to be brought into the States and fattened and processed. Of course, that annoys the hell out of the cattle farmers, but Trump's faced with the twin forks of a dilemma. The price of beef in the US is huge, very, very high, very expensive meat. And he's authorized a big increase in the quota for Mexican cattle to come to the US in an effort to try and reduce the price of meat, which is one of the staples for everybody. And of course, he'll find some opposition wherever he goes on those sorts of issues. They're very, very difficult. Oil and gasoline are highly correlated. And remember that these correlations will last for a period. They're not necessarily forever permanent. Some of them pretty much are. Equities and Germany's DAX, they're highly correlated with each other. Gold and silver the same. Some of the other correlations that you'll see on that table from more research are temporary, and they come and they go, which makes life even more interesting. So the importance of all correlations, the most important of all correlations, are actually the daily and weekly Danielcode numbers for target recognition. Now, over the years, you will all remember, those of you who've been with me a long time, and some of you have been with us a very, very long time, I will always be banging on about the markets finding target recognition, the markets turning at the Danielcode numbers. And as a matter of correlation, there is nothing I can think of that is more correlated than markets and those numbers. And to me, the Danielcode price targets are an absolute essential part of trading because we have a chart archive. We've got over, I think well over 40,000. Yes, there's Jeff made a comment. Yeah, he's not helping US farmers, talking about the 300% increase in the quota for Mexican cattle. That's for sure, Jeff. Anyway, over the many years that we've been together, you've heard me going on and on and on like a cracked record about these Danielcode numbers, about the markets finding target recognition and turning at these Danielcode numbers. And if you go to the Danielcode website, there's a link that says Chart Archives. And if you have a look in there and be patient, it's a massive, massive file. Terry's reorganized all of the Danielcode members' charts by year and by a month. So you can just go through all of them. As I say, there's well over 40,000 charts, all of which I've created by hand. And you'll be flat out to find a market that's ever turned anywhere except at the Danielcode targets. And that is just such a strong point. I can't emphasize that enough. And it worries me because we see from the website which pages you're looking at are our subscribers. And most of you are not looking at the members' chart pages at all. And those of you who are, you're looking at one or two charts. And I really think that there is nothing more important in trading than the Danielcode time and price ratios. Remembering that when we learned what the Danielcode was and where it came from, which is something you would learn if you took the TTT course lesson number 1, what we found is that the whole understanding of what is the Danielcode comes from understanding time. And then once we'd isolated and recognized the various dominant time cycles, what I did is quite simply, I just said, I want to turn these into price, see what they're doing. And to do that, there was no magic. We simply took the same ratios that had been displayed on the charts as vertical lines and slapped on exactly the same ratios as horizontal lines. And it's quite extraordinary. That's where all of our Danielcode numbers come from. They're actually time signals recreated or altered to display as price signals. And it is so dominant markets. You're really flat out finding a market that's ever turned anywhere without target recognition at the Danielcode numbers. And that is so basic to your trading. If you don't have those numbers on your charts, really you're missing something, and you're missing something incredibly important. So I've been doing those members charts since well before 2007. And at the moment, we cover 9 Forex and 11 futures markets on a daily basis. The biggies, crude oil, S&P, gold, and UST bonds are also covered with weekly charts. They're called our 6-day charts. In the Danielcode lexicon, 6 days is our Danielcode week, if you like. And those charts are refreshed twice weekly and more often if required. You'll see, and I suspect shortly, that once the market gets a bit more volatility, although it's pretty fantastic where it is right now, but as the market gets more volatility, sometimes I've got to refresh those charts every day for 2 or 3 and sometimes 4 days at a time. But that's what we do. And as I say, all those charts are in the chart archive at the website. Do take some time and have a look at them, understand how vital they are. And it's a lot of work. It takes 3 people a combined 40 hours just to run the DC numbers every time we post them. So it's a whole lot of work. And the back office, the number of other charts that we have to maintain so that we can run our regression analysis, etc., is huge. And unfortunately, I've got two lovely ladies in New Zealand who dedicate almost all their time to just updating Danielcode charts. So in the 19 years that Danielcode's been in the public domain, much has changed. We have lots of new products, and other products we used to emphasize are no longer there. But the daily Danielcode numbers are the one constant. They have been with us since day one. The first thing I ever did for the public, create the Danielcode numbers, and I'm still doing it. But if you're not getting the benefit out of it, you're really missing a huge part of the knowledge about trading. And as I say, I am not aware of anything that is more correlated with financial markets than those Danielcode numbers. And if you know how to create them, they work on stocks. They work on lots of other things as well. They even work on horse racing, if you want to know how far my research goes. But there's a little aside for you. So I want to talk to you today, start off by talking to you about the soybean chart and China. And there's a backstory. 2 years ago, China, which was the major buyer of soybeans in the US, decided it was going to change its suppliers. And it stopped buying beans from the US and changed to other South American markets. And that meant that last year's crop of soybeans was not entirely sold, and huge amounts of it had to go into storage. And the thing about crops is when they're ready to be harvested, they're ready to be harvested. And they are huge. It's a massive industry, the growing of beans. And they need to be sold. They can't be stored indefinitely. And there are limits to the various methods, silos that are available for the storage of beans. So this year, of course, we're running into our second year. The American farmers, I should say, are running at their second year without China as a major buyer. And that's why soybean prices have been going down, because it's, ready to harvest, ready to sell. And where are you going to put this new crop? All the storage facilities are pretty well full. How much can you stretch them? How much can we store? It can't go on indefinitely. But it's been very, very bad for farmers. And one of the main things that Trump wanted to talk about as a result of his meeting with President Xi of China yesterday was that China has agreed to purchasing some very substantial amounts of soybeans, which is a great relief for US farmers. And what happened yesterday, for you people today, remember, I'm at the other side of the world, so it's Friday for me, and the market was last night's market, but it's the chart we're looking at. And what happened is we had a sell signal in soybeans, which was pretty understandable because that market's been going up for quite a while, and it's been going up recently in anticipation that Trump would get a good deal out of Xi. Hopefully that China would return as a major buyer of beans, and also this argument applies to wheat as well. So that was pretty logical. And what you had down below it was a gap, a big gap. You can see that greeny stripe on the chart. And that's the gap where the market got super excited about the probability, or the possibility at least, that Trump and Xi were going to come up with something that would assist US soybean farmers. Now, markets hate gaps. Equities, commodities, everything, they all hate gaps. In commodities, the tendency is that if they're not filled immediately, they'll not be filled for a very long time. But what we have here is a gap sitting below that retracement. You can see the retracement from the high before today's high, had the dominant Danielcode 59.32% retracement sitting at 1070, correct to that little arrowhead you can see there. It's called a correct. And that's right at the top of where the gap was. So the vast majority of people who were short, and I suspect very, very few of them, perhaps only a couple of handfuls, had that Danielcode retracement on their chart. And they were all looking for the gap to be filled, which made them absolutely prime targets for a reversal, which is exactly what the market did. It wiped out all those shorts and a few more as it rallied up to a new high. And you can see that high is almost exactly at a Danielcode retracement. This is not the blue line, it's simply the Danielcode retracement tool, which most of you have, or if not, you can have it by doing a TTT or a Danielcode tutorial. You should have that tool. It's very important, it's vital in fact. And it's left the gap untouched. Well, why am I telling you this? Because I want you to understand how exact markets are. I want you to understand how precise markets are. I was talking to a surgeon recently. I've got cataracts to come out and another procedure on one of my eyes that he wants to do. And I was talking to Mrs. Needham saying, you know, I'm really not happy about this, any of it. And I know I have to have the cataracts, but I don't want to have surgery on my eyes other than cataracts, which are quite straightforward, the surgery for that. And I was thinking, I'll bet they're not as accurate as my Danielcode charts. And you can pretty well guarantee that the degree of accuracy of these markets is absolutely astounding. And the great news is that almost nobody understands that. Almost nobody understands how incredibly accurate these markets are or how precise they are when you're measuring them against the Danielcode ratios. So here is this market, elected to sell signal, has been on a huge tear up, leaving this massive gap down below a few days ago, and heading down. The logical assumption was it's going to fill that gap. Well, look what it did. That gap, the low of it, 59.32, was the Danielcode percentage, which took it to 1070, correct 2. Okay, this market moves in 4 ticks, 2460. Let's have a look at the next one. This is where you need some intraday skills, which Michael Balmer will be interested in because he has all those skills. And this is what happened in this market. And this is the 60-minute chart. So what I'm suggesting to you is that a fully trained trader will understand the necessity of some short-term trading knowledge. And if you go to a 60-minute chart, that's really, really basic. It's not too stressful, and it's really basic. But have a look at this. This market roared down, and we had a sell, a buy, and a sell. We had the big bar down today, and look where that stopped. Look where that low was. The red line actually comes off the daily charts. In other words, that red line has been on there since the previous high. And straight off the daily chart, the members' charts, if you look at them, you should have these numbers on your charts because they're absolutely dynamite. So you ran into a tier 3 buy signal, a time buy signal at that low, exactly at the Danielcode number. 4 or 5 bars later, you got the retest of that low, another buy signal, up it went. $1,100, $1,200 just for sitting in that one trade and being aware of it. And that was a trade that fooled almost everybody because the vast majority of traders are sitting there waiting for the gap to be filled. And gaps are usually a magnet to market, so that's a very high probability to have that assumption. But have a look what I'm trying to show you here. The low of today's bar, as I say, went down to fill the gap. The low of today's bar was one tick variance from the Danielcode red line, which was at 1068, correct 2. The gap was sitting there right underneath it. How perfect is that? Let me show you. This is about precision. Very, very careful. The market is being very, very careful. You can't believe how careful markets are and how precise. So that gap starts at 1070 correct 2 and it runs down to 1060 correct 2. This was a high momentum move on the day's bar. The sell was elected. There was a TO3 and the blue line sell signal there. The sell was elected. This market roared down. The whole world assumed it was going to fill the gap. That was Enid Blyton's lesson for beginners, pages 1 to 3. And the low of today's bar is 1070 correct 4. That's one tick above where the gap started. The high of the gap is 1070 correct 2. The low of today's bar is 1070 correct 4. That's one tick variance, one tick difference between the low in a high momentum move, largely expected to go in and fill the gap, and it stopped one tick away from entering the gap. I mean, that's how precise this stuff is. Extraordinary, isn't it? But you need to understand, and I suspect the vast majority of you don't understand, how incredibly precise this Danielcode is. And for most of you, and I admit I was part of that cohort for many, many years, if you're raised on traditional ideas of trading where there's support and resistance, and it's there or it's thereabouts, and it might be breached or it might not be breached, you would have no understanding of how precise Danielcode trading is. It's exact and priced to the minutiae. One tick further on that high momentum bar, and it was roaring on its way down, I can assure you of that. It stopped exactly one tick. The smallest amount the market can move is one tick. It stopped one tick from where it would have breached the beginning of that gap. Incredible, isn't it? Yeah, and I don't think most of you understand that. And then, of course, it turned and it roared up. It got everyone short, and that's going to cut their heads off. Look where it closed for a huge momentum bar. Look at the highs just a couple of ticks away from the next blue line. Where was the close? Almost exactly on the 1108 blue line there. This stuff is amazing, and it's precise, and it's incredible. So I want you to think about that a whole lot, please, and understand that exactitude and that precision makes the Danielcode different to any other trading system in the world. And that's why it's so wonderful. Okay, what is going to happen to these markets going forward? Well, one of the big things to think about is that on the 5th of November, which today in down under at least, today is the 31st, means we've got 5 days to go. So that's going to be 2 weekends, 3 days. Wednesday next week, the Supreme Court is going to start hearing the case about Trump's tariffs. Now, already 3 of the lower courts, mainly the federal courts, have held that the tariffs declared by Trump are illegal, and he's being sued by a couple of small businesses that claim that they're adversely and unconstitutionally affected by the tariffs. And on appeal from the lower courts, it's now going to the Supreme Court of the United States, which is the ultimate court of appeal for the US. And they have done something very unusual. They have given an expedited hearing. Sometimes cases in the Supreme Court can take years and years and years. On appeal, the court decided to give this particular issue an expedited hearing, and it starts next Wednesday. So I've talked to you about this in our last couple of webinars, and what I've said to date is that being an attorney, I think like all attorneys, which is why almost every attorney in the world thinks that Trump's declaration of the tariffs, this is not the tariffs against steel and aluminium, these are the other tariffs against every country, some of which are highly discretionary, because, for example, Australia many other countries run surpluses, trade surpluses with the US. That is, they buy a lot more than they sell. So it's very hard to find justification for tariffs against countries that are already running a trade surplus with the US. But nevertheless, Trump has done it. And that was my view of it. And I had to think about where the numbers would likely be on the Supreme Court. And I was pretty confident that not only would the Supreme Court go to declare these tariffs unconstitutional, but I thought I had a pretty good handle on who the justices would be that would go with that vote. And I've now been having another think about it all because in the same way that the dot-com bubble eventually exploded because of debt, in the same way the run-up to 2007 eventually exploded because of debt in all of these mortgage transactions and the packaging of those transactions. So it seemed to me that America has got so much debt that at some stage that's going to explode. Well, the test is whether the court is going to find that the massive debt that various presidents, starting with Bush, George W., Obama pretty much doubled the US debt on his own. And since then, of course, Trump had a big spending spree, and they're on another one now. And US Treasury expenditure year to date is well in excess of what it was this time last year. So the problem is that this debt, if you took the view, does it matter now? Is this a true emergency? Because that's the basis that Trump said he has sufficient power as president to impose these tariffs, because the Constitution on its face reserves all tax and anything that is in the form of a tax. It reserves those rights specifically and strictly to the US Congress. And there's nothing in the Constitution that says that a president should specifically have those powers. And remember that the US is a republic. And under the republic and how it was formed, specific powers were transferred from the states to the federation, to the republic. And if those specific powers have not been identified and specifically granted as part of the Constitution to the federal bodies, then those powers remain with the states. So that's what this whole issue about states' rights is always about. So you can take the view that, and I think this is the view that the plaintiffs have taken and will continue to take, is that, yes, sure, there's a massive amount of debt being taken on by the US, and so what? It's been incurring massive deficits for the last 45 years, and it's never been an emergency yet, so why would it be now? That's one attitude, and that's the attitude I thought was probably the correct interpretation of what's going to happen next week. But thinking past that, there's some support, I think, for Trump's position that we know from actuarial projections that if the US continues, and this applies to almost all Western countries, incidentally, this is not a problem that just the US has. Almost every Western country is awash with debt, and you've got the same political system that the first political party that goes on and says we're going to cut on external debt is committing suicide. Electoral suicide guarantees they won't be getting an invite to the party. So how are you ever going to get control of this debt? Well, certainly these tariffs are contributing to bringing in a massive inflow of money to the US Treasury. And I think Trump can argue that, okay, this year's no different to last year or the last 45 years, but at some stage, this continued gaining of debt, incurring debt, increasing all the time. Eventually, it's going to blow up the whole system, and either the diffuse is going to default on one of its obligations, or it's going to debase its currency by issuing so much currency that inflation goes mad and the dollar becomes worth a whole lot less. And I think Trump can argue that if not now, then when? And I think that's a terribly strong argument, because I think debt is a real and present danger for all of our Western economies. Okay, so there's my view on it all. I'm sure it'll be interesting. So the party starts on Wednesday with oral argument in the Supreme Court, and I have no idea when the court will think about releasing its judgment, but you'll find a whole lot of interesting clues in the oral argument. So if you're interested in learning to trade, folks, or you want to understand and do any of these things that you see me doing or talking about at these webinars, I refer you to our new TTT series, Teach Yourself to Trade. It's a short video series and covers a huge range. These 4 videos I've got here are embedded on our website because they're incredibly important. Video number 1 comes from Mark L, who's with us today. He's an absolute Danielcode stalwart, and he was one of the early adopters of my time trading tutorial. And this video 1 is his interview with me, where he so generously tells us all about his experience learning and actually using Danielcode time signals, creating and trading Danielcode time signals in financial markets. And it's a vital piece of information. Video number 2 is something similar, but it's from Justin, who is a charming and delightful young gentleman, really strong Danielcode member, been with us for a long, long time. He lives in the beautiful Hunter Valley of New South Wales, which is equivalent to America's Keeneland, if you like, Kentucky, where all the beautiful horses are. And video 4 is an extraordinary document. It's Justin's analysis of so many markets, you'll find it hard to believe. It's Forex markets, futures markets, commodity markets, a whole lot that we don't cover at all. But Justin's cast a hugely wide net, and he's gone through and he's scientifically back-tested, as he says, over 100 years of data in total. His various tests that he applied to these markets, some of them for 1 year, some of them for 4 or 5 years. But in total, there's over 100 years of data that he's put through his analysis of creating and trading Danielcode time signals. And he's been so generous. That is like work of many, many years, I assure you. Just the magnitude is extreme. And he's been kind enough to share that with you in this video. So we're most grateful to Mark L and also to Justin for their generosity in sharing, which is, for some, it's a lifetime's work. And I really do recommend you take half an hour out of your busy life and go and read video 1, 2, and 4. Don't miss them. They're extraordinary, extraordinary documents. And once you've done that, you'll be able to understand all about our TTT, Teach Yourself to Trade video series. And the links to that are here. It's on our website. You can read all about it. If you think that a career as a professional trader is in your future, or even as a part-time trader, the best way to learn is to let me know, and we'll get you started on one or more of the TTT courses. So this is what we've been doing for the week, and I share these with you every time we do a webinar. Focus now on where these markets have turned. You'll see the blue lines, which are Danielcode extensions of the range. These are not old highs or old lows. These are not Fibonacci numbers. These ratios are created by the market itself. See how incredibly accurate they are. You see we had a nice run up on this crude oil market. We're short at the moment. This is the S&P. Very interesting, very tricky the last couple of days up here. And what does it all mean? Well, look at the precision. And then when you do this, have a look at the Danielcode website. And you can see another chart that I posted probably yesterday of this market and the NASDAQ just gapping and going massive enthusiasm in the rally still, but hitting the Danielcode numbers all the time. That's what I'm trying to get through to you, that if you have these numbers on the charts, trading is going to become real for you. You're going to understand things that you can only guess at the moment. So we had a couple of goes on the long side here, nice little bit of trading, and then short, we had a TO3 sell. It's been elected twice, and we've been in and out a little bit there, but we're sitting short in that market at the moment. Here's gold, which has been an absolute wonder to trade, hasn't it? This rally in gold has been absolutely extraordinary. And this little minor correction that we're getting now is doing exactly the same. We made 17,000 just on the last stages of the rally on the long side, and we're sitting at almost exactly the same money, 17,000 short into the today's buy has got us long, but I've run this down to the place where the buy signal was elected. Massive amounts of money. If you're day trading, this is the argument I've been presenting to you for a number of months now. These ranges that these markets are making are so extraordinary that day trading has become a very, very viable and quite important opportunity. And we can teach you all of that as well. Here is copper. And I'm showing you this for a particular reason. I always show you our trades, all markets. We don't make any exceptions to it, good or bad. This is one that I missed completely. You can see I am ashamed to admit it, but yes, I have made a mistake here. This was a classic TO3 sell signal. This market roared up on Wednesday and stopped at the red line at 527.95. There's your perfect target recognition. Both of the stochastics were overbought. The momentum indicator was sliding off. That was an absolute classic TO3 sell signal. And I have to admit that I did not post it. I don't know why. I had a mental blank at some stage. Well, I guess considering how many of these I do, and it's a long time since I've missed a signal, I can assure you. But this one I have to admit that, yes, I missed it. And we had a flip me sell signal sitting under there. But this was a classic Wednesday game. It's a classic TO3 sell signal. And you should have been short 2 ticks below the low of Wednesday's bar, which made you a nice bit of money. So I don't miss much, and you can see with the rest of these charts, I show you this every week. This is natural gas, which has been a great trading market, and the symmetry in this market is quite extraordinary. 2,400 up, 3,000 down, 2,800 up, 1,500 down, and it's now up 1,700 on today's buy. Pretty extraordinary stuff, isn't it? Nice stuff, wonderful market. And the ranges it's doing intraday are quite extraordinary. This is the NASDAQ. And you had a TO3 and a blue line sell signal right at Wednesday's high. Look how precisely the market found that number of 25,375. And look even where it closed on Wednesday at the blue line below it, which is still sitting there at 26,239. This market has run up and down these Danielcode numbers in an incredible manner. As I say, have a look at the chart on the front page of the Danielcode website, and you'll see how this market's just been gapping up roaring up and finding the blue lines all the time. And I do mean all the time. Without this target recognition, it's almost impossible for markets to turn. Okay, think about that again. Without this target recognition, it's almost impossible for markets to turn. That should be the first criteria that you're looking at when you're creating your time or price signals. Do we have target recognition? That's question number one. This is the Russell, which gave us a pretty much perfect TO3 sell signal right at the high at 25.67. So only a couple of ticks variance there. And it started to go down. It had that outside bar on Wednesday, which got us long then short, and it failed on the buy side, which is why I've got a little cross with the word fail next to it to tell you that yes, we got long and then we got short again, which is what you should have done. And we gave a bit more of a gap down today, not a gap, rather an impetus move. But it rallied up very high. This is a big bar, but not much change from yesterday to today, really from the lows, if you look at that. And I suspect that there's a buy signal on that bar for Friday's trading. Beans, this is this big question I've talked to you about at length before. This is why this is our normal trading chart. But there's a whole lot more of interest in here. Because as I showed you, the retracement from the previous low, these red lines you see on this chart are now taken from, this must be Wednesday's high, surely. But that's where the chart sits right now anyway. Silver, nice little trade down, nice little rally back up today, 12,000 down, 7,000 up. Getting support from a FIPME sell signal, which has not been elected. Again, see how accurately the market finds those numbers. And it's another market with massive intraday trading. Wheat, this is interesting because soybeans are okay. And soybean, this is a classic, by the rumor, sell the news. Trump's announcement that China was going to resume buying soybeans and wheat on a large scale gave a lot of relief to soybeans. That's why it did that wonderful outside bar, not even putting a toe into the zone of filling the gap. And the wheat's a bit different. We had a TO3 sell signal for today's trading, which was elected, and down it went. It's run a long way off the low. It's not a whole lot of momentum in this move today because if you look at the close, it's right on the Danielcode red line, isn't it? But you've got wheat here doing the classic of buy the rumor, sell the news, and that was wheat. This is UST bonds, one of my favourite markets. It's been a little bit constrained. I suspect that the plunge protection team have earned overtime on their efforts this week. This market is holding fairly strong, but it's in a very perilous position. And if we get any significant move to the downside, it's likely to accelerate. Remember from our long-term chart, what's supporting this market is 6 Danielcode deviations from the mean, which you've seen on our long-term trend chart. That's still the most important support, and the market's not terribly far away from that. So, what have we got here? A blank page. Must have been interesting, must have been in a hurry. Here we are. If you haven't already, folks, do please help yourself to a free trial of everything at the Danielcode. Just go to the website, www.thedanielcode.com, hit the register button. If you have any issues, contact Terry at support@thedanielcode.com and he will assist you. And finally, from me, this is our disclaimer. I do think it's important that you understand that it's very easy to lose all your money trading futures markets if you don't know what you're doing. And that's the same as anything in life, isn't it? You wouldn't get in a car and try and drive it if you didn't know how to drive. It's the same thing for financial markets. Don't attempt to trade them unless you're comfortable with the situation, that you have been educated, that you know what you're doing, that you have an understanding of markets. And the best way of doing that is send me an email, jneedham@thedanielcode.com, and let me know what you're interested in, and I will be happy to organise one of our tutorials for you, whichever one is appropriate. So that's me for today, folks. Thank you so much for being with me. Do keep thinking about what's going to happen on Wednesday. I think it's going to be huge. And thank you, Jeff. You enjoyed that. Thank you for letting me know. Very kind of you. So that's it for now, folks. Michael's enjoyed it too. Thank you, Michael. And good luck with your trading in the future. I'll be back in 2 weeks, maybe sooner if there's any great drama. And if there's any particular topic that you would like me to talk about, do send me an email, please, jneedham@thedanielcode.com. Tell me the subject that you're particularly interested in, and I'll make sure I do some research and talk to you about it when we get to that stage. So lots of gentlemen have come, and ladies, I think, come in late here. George is one of them. Greg from ex-Colorado Springs, now Texas, is with us. Chip Stevenson's with us. Hello, Chip, long time since I've seen you. Glad to have you with us. And a number of others. Mark's with us, plenty of Marks, many Marks. Michael's, more Michaels, yeah. And Rob H. from New Zealand. Rob's a very experienced trader and understands markets perfectly. Good to have you with us, mate, and I trust you're happy and well over there in the land of the long white cloud. And that's it for me until now, folks. Steve, many Steves, yes. Thank you for being with me, and enjoy your trading tonight, and stand by for action in the middle of next week. I'm sure it'll be epic. Goodbye for now.